Nowhere to hide in the first quarter of this year. Stocks, bonds, and even crypto have fallen at the same time. This is Michael Smith, and welcome to the Lowdown. Hey everybody, joining me today is Chris Roberts. If you're not familiar with Chris is my right hand. Chris, welcome.
Thank you, Mike.
Well, we've had quite a week. We've got pandemic stocks back to pre-pandemic lows. We've got major technical indices being broken. I mean, the S&P is not taking out the March low. However, the growth stocks have taken out that March low. And I'll just remind you, this is one of the reasons we've been actually warning people. We've been expressing many for, I think, months now to start looking at their financial plans, making sure they're not taking excessive risk, and also looking at maybe that rotation from growth to value. And I'll tell you what we're seeing this past week, I think it really pounds that message.
Exactly, Mike. And I just want to reiterate that, it's always about, making financial planning driven investment decisions, right? Aligning your portfolio with your financial plan. It's exactly what we do here. It's something we've been harping on throughout the year. But to your point on growth versus value, I mean, we've seen it this year, right? So the triple Q, QQQ, one of the most popular growth stock indexes of the last few years, something that's just flourished after the pandemic lows of March of 2020, so to speak. I mean, that's down over 20% year to date. Whereas, like, for example, the IUSV, right, the iShares Value Stock Index, if you will, it's only down about, 4.5% year to date. So it just shows you how much investors are really flocking to safety. They're flocking to strong balance sheets. We're really flocking to the companies that can really absorb the effects of ongoing inflation, interest rate pressures. We know growth stocks are highly leveraged, so to speak. And then, of course, from a valuation perspective, right, we've got rising interest rate pressure. All these growth stocks, their valuations are all based on what's the risk-free rate of return. And right now, with that rate rising, so to speak, that we got to discount those values back even further. So that's why we're seeing that sell-off in those growth stocks. But it also creates opportunity as well. So I think that as we progress throughout the rest of the year, we're probably going to continue to see that defensive push until inflation pairs off a little bit, until we get better clarity on interest rate policy. So I think that this trend's going to continue. But it just goes to show how you want to stay within your boundaries of risk, but it also highlights the importance of rotation as well.
And that's why all eyes are going to be on the Fed next week. And as a matter of fact, if you're thinking of using the Federal Reserve as guidance, let's just remember what happened a year ago today.
These base effects will contribute about 1 percentage point to headline inflation and about 0.7 of a percentage point to core inflation in April and May. So significant increases, and they'll disappear over the following months, and they'll be transitory.
Today actually marks 1 year since Jerome Powell, the Federal Reserve Chairman, came out and said, now, everyone's favorite word, transitory. Well, Chris, what do you think about that transitory comment?
Well, I'll just say this, Mike. This time last year, what was CPI? It was 2.6% year over year, and now we're pushing 8%. So to speak. So I think the transitory narrative, so to speak, has really come off, if you will. And it really tells us just how much the Fed is willing to pivot, right? And that's the key thing to keep in mind here, and that's why we're going to bring up this chart. What the Fed said yesterday isn't going to necessarily be true tomorrow, if you will, and that could create a significant opportunity for investors because a quick pivot from the Fed from this rising interest rate policy to potentially a flat or even declining interest rate policy could provide a massive catalyst for different asset classes across portfolios.
Well, despite what the Fed said, right? I mean, you heard Jerome Powell. He said transitory inflation would be gone within a few months. I think we all know that is not true. I think many of us believe it's going to be here a lot longer. But I'll tell you what, one of the things we have seen in the past is when the Fed has pivoted. And I think when they actually do, right now, I think they're, it changes every day, by the way, but I think they're expected to carry about 7 rate increases, probably the next one, which is going to be next week, 50 basis points, then 75. They're probably not going to get too far. They're going to have to pivot. And one of the things about that, trying to catch that pivot is going to be difficult. This is why we said be positioned ahead of this volatility, because when it reverses, you're not going to catch it.
Well, and just to that point, we're talking about when it's going to happen, if that pivot's going to happen. At the end of the day, this is all about uncertainty, right?
Correct.
Investors hate uncertainty. Markets hate uncertainty. And that's why we've seen such a precipitous fall in different asset classes so far this year. It's really not so much the fact that interest rates are going up. It's the fact that we have no idea how much they're going to go up. We have no idea what inflation's going to do. Granted, we can make forecasts and we can talk about these in internal meetings and all of that stuff. But at the end of the day, they don't know where things are headed, and therefore markets hate this level of uncertainty. And that's why we've seen these sell-offs. That's why we've seen the swings. We're seeing the swings this week. I mean, this week has been crazy volatile. Go ahead.
Well, in the past, what we've seen, and you know, anytime we get year-over-year declines in the S&P, what is with the Fed? The Federal Reserve has always been to the rescue. Now, I think they're willing to pause a little bit, let a little bit more pain in the markets as we're seeing now. Let this push through. They need to get at least probably 2 meetings where they raise before cracks start to happen, and then they reverse costs.
And they have to reload the proverbial monetary gun, right? You know, at the end of the day, if we're going to pivot, we have to have something to pivot off of. So rates do have to go up in the near term. I think that's a foregone conclusion at this point. But it's more so what happens when we get into August, September, October of this year. You know, does that create a pathway for them to pivot if rates are at 1.25%, 1.5%? You know, that changes the narrative for them significantly, and it changes the narrative for investors as well.
Well, that's why I feel like we're in the kind of the eye of the storm right now. Next week, they're going to have to do something. And of course, now, again, the market's expected, absolutely. But they do anything beyond market expectation. That's going to be what we want to see here.
I love your storm analogy, Mike. And that's just because, you know, we all live in Houston here. We're all very familiar with hurricanes, right? The closer they get to the coast, the more that cone narrows, so to speak, right? So as you said, we're in the eye of the storm right now. The hurricane's intensifying, so to speak, but we're getting closer to the coastline. So we're getting more and more clarity over time about where interest rate policy is going. But right now, we're really at the point of maximum uncertainty.
So, Chris, one last thing. Let's talk about the bonds. I mean, this has been, you know, again, for fixed income, there's never been a year from January 1st till now having a bigger sell-off in the bond index than what we're seeing. This is historic.
Yeah, and I mean, just look at the chart here, Mike. I mean, at the end of the day, you know, this chart, what it represents is the Bloomberg Aggregate Bond Index, you know, at different points, you know, or different years, I should say, over time. And you can see all these little gray lines, red lines, green lines, what have you. The black bolded line is how much the Aggregate Bond Index has sold off so far year to date. And this goes back to what we were talking about before. It's uncertainty, right? At the end of the day, we'll probably see a reversion to the mean. As interest rate policy becomes more clear, we'll probably see the aggregate bond index appreciate. You know, we've never seen a double-digit decline quite like this before. But at the same time, it also creates a lot of opportunity for investors as well. I mean, over the last few years, what have we been harping on? Low yields and just the trap of fixed income.
Correct.
So we're in a very unique opportunity right now where we can actually pick up debt, or investors can pick up debt at reasonable prices, at reasonable yields, and actually bolster their portfolios. Not only that, we were talking about a Fed policy pivot. If the Fed does pivot, that creates great rebalancing opportunities for investors, because that means those bonds they buy at these steep discounts could very well have significant capital gains as well. So, you know, I think that every single sell-off, every single, you know, catalyst or negative event, if you will, creates opportunity for investors. And I think we need to be keenly aware of that and ready, and investors need to be ready to react.
Well, also look at that chart there, that huge decline in bond price. Remember, this is where I think it becomes very challenging for the Fed. Bonds are what? They're collateral for a lot of loans. And look at the loan to values. That's the collaterals dropped significantly here. So that's going to be a challenge for the Fed to continue forward with their policies. This is why we think a pivot's ahead.
Well, I mean, what were we talking about all along? Dual mandates turns into a 3-point mandate.
Exactly.
Now it's a 4-point mandate, right? They're trying to balance so many different things at once. I think at the end of the day, what we should anticipate is probably a little bit more clarity, but a little bit more pain in the near term. But like I said, that can create opportunity for investors, especially fixed income investors as well. At the end of the day, though, I mean, we can kind of go back to our thesis here, Mike. At the end of the day, we're at a point where we really can't raise rates to the point where people ask all the time, you're like, well, are rates going to 5, 6, 8? We're seeing 1980s style, you know, rate hikes. At the end, I just don't see that happening. I mean, there's too many long-term macroeconomic factors to prevent that. So, you know, the old adage of finding yield replacement in portfolios is still true, but fixed income definitely still has a place in portfolios. It's a great source of liquidity and safety in normal conditions, at least. And I think that's going to reign true for the foreseeable future.
Well, Chris, thanks for coming on. It's been a rough week. We're going to be looking at the Fed next week and seeing what happens. Thank you for joining us on The Lowdown.